Welcome to This Explainer. Okay, tell me if this sounds familiar. You're watching the stock market recently and suddenly, bam, you find yourself completely baffled by these wild, totally unpredictable fluctuations. I mean, one minute it's dead calm, right? And then the next you get these massive whiplash-inducing price swings that honestly make absolutely zero logical sense. Well, I'm here to tell you, you are not imagining things. Today we're unpacking exactly why this is happening. The reality? The entire market structure has fundamentally shifted into what is essentially a giant financial casino. We're looking at the zero DTE casino and exactly how dealer hedging is literally dominating the market.
Okay, let's dive into this. 63%. Just let the sheer scale of that number sink in for a second. We're not talking about some minor metric or, a fringe statistic from a dark corner of Wall Street. No way. This number represents the absolute core of today's market volume. It's the cold, hard reality of what is actually moving the needle right now, today. So, what exactly is this 63% made of? Well, it points to a massive tectonic shift in how trading happens. A shift driven entirely by same-day options bets. Before we get into the nitty-gritty mechanics of how these bets work, you really just need to grasp the sheer magnitude of it all. A clear majority of the action you're seeing on the ticker, it is probably not what you think it is.
To really grasp what's going on, we have to look at the stark contrast between what the market used to be and what it has become today. Think back to that romanticized idea we all grew up with. You research a great company, you look at their long-term fundamentals, their earnings, the leadership team, their product pipeline, and you thoughtfully buy a tiny slice of that company to hold for the future. That was the old market. But the new market, it tells a radically different, much faster story. Today's stock market is no longer primarily about the companies themselves. The harsh, kind of mind-blowing reality is that the market has transformed into this giant churning hedging machine designed to support same-day options trading. The underlying assets, the actual stocks of the companies we know and love, are now frequently being violently pushed and pulled, not by their own merits, but by complex derivative hedging that's happening relentlessly in the background.
Now, what's really interesting about this slide is how this massive 63% chunk, representing same-day options, completely swallows traditional trading volume on the S&P. Think about what that actually means. All other S&P trading, every traditional long-term investment, every mutual fund rebalancing, every retail investor just buying a single share of their favorite tech stock to hold on to for 10 years, all of that combined makes up just the remaining 37%. Same-day options have completely overtaken the system. It is the dominant force. It's not the sideshow anymore, folks. It is absolutely the main event.
So, what exactly is this massive force we keep talking about? Let's break down this crucial piece of jargon nice and simply. Zero DTE. It stands for 0 days to expiration. Now, when you trade a normal option, you're buying a contract that gives you the right to buy or sell a stock at a certain price by a certain date. Traditionally, those dates were months, maybe even years out in the future. But zero DTE options, they expire on the exact same day they are traded. When the closing bell rings today, those contracts completely vanish. They're either worth something or they are worth absolutely nothing. Zip. It is an incredibly fast-paced, super high-stakes environment. To bring it back to our casino analogy, if traditional investing is like planting an oak tree and watching it patiently grow, a zero DTE option is like walking straight into a casino, putting all your chips on red, and just waiting to see where the roulette ball lands before the day is out.
But here is where the plot really thickens, and where we formally meet the house in our casino analogy: the options dealers. These are the giant institutions selling these millions of fast-paced zero DTE contracts to the gamblers. Now, they have a strict, non-negotiable operational rule they have to follow called being delta neutral. So what does that mean? It means the dealers absolutely cannot act like gamblers. They have a strict requirement to balance their books so they never take on directional risk. If the market rockets to the moon, they shouldn't lose. If the market crashes through the floor, they shouldn't lose. They just want to safely collect those tiny little fees on millions and millions of trades. So to survive this absolute flood of same-day gamblers, the house is mathematically forced to constantly and perfectly balance the scales. They literally must remain neutral to the direction of the market at all costs.
Let's move to and see how this builds into a real-time trap broken down into 3 distinct steps. Step 1. Our gambler steps up and buys a massive block of zero DTE options, essentially betting that the market is going to go up by the end of the day. Step 2. The options dealer takes the other side of that trade. But wait, remember the golden rule. The dealer must stay delta neutral, Because they took the other side of the gambler's aggressive bet, they are suddenly uncomfortably exposed to risk. So, to balance their books, we immediately hit step 3. The dealer is forced to instantly hedge their position by actually going into the real stock market and buying or selling the underlying stock. This is a real-time, mandatory reaction. The dealer doesn't give a single thought to the company's fundamentals. They are mathematically forced to buy or sell the stock right then and there just to cover their options exposure.
Which brings us to a rather incredible realization, beautifully summed up by an old phrase, the tail wagging the dog. See, in traditional finance, the stock itself is the dog, and the option, which is a derivative of that stock, is just the tail. The option's value is purely supposed to be derived from whatever the stock decides to do. But because of this massive, overwhelming 63% volume of same-day options and the forced hedging by the dealers trying to cover those bets, the dynamic has completely flipped. The sheer volume of derivative options bets is now forcing the dealers to aggressively buy and sell the actual underlying stock. The tail is literally violently wagging the dog.
So the crucial point is that the direct consequences of this delta-neutral trap on overall market stability are absolutely severe. First off, we get massive, totally irrational price swings. I mean, seemingly out of nowhere, the market will just suddenly drop. Not because of a terrible earnings report or some big change in leadership, but simply because dealers are mathematically forced to dump stock just to cover their options bets. Second, this creates a complete detachment from actual company fundamentals in the short term. The stock price totally loses its connection to the company's real-world value because the trading volume is being driven by mechanical hedging. And third, all of this ignites a real-time, forced hedging feedback loop. It's crazy. A small drop triggers gamblers to buy put options, which forces dealers to sell the stock to hedge, which causes the stock to drop even further, triggering even more rapid-fire options buying. It is a highly volatile, completely self-fulfilling cycle.
And this brilliantly illustrates our central premise today, the zero DTE casino, how options dealers now run the NYSE. It sounds super dramatic, I know, but the pure mechanics we've just walked through absolutely prove it out. The traditional function of the New York Stock Exchange, where buyers and sellers thoughtfully debate the true value of American enterprise, has been effectively usurped. The primary driver of daily movement isn't the careful long-term investor anymore. It's the dealer. It's the dealer desperately sweating to balance their books, covering their rapid-fire same-day options bets, and essentially accidentally steering the entire massive ship of the stock market as a byproduct of simply trying to stay neutral. Which leads us to a very serious question, and something we all really have to grapple with moving forward. If same-day casino mechanics are forcing massive price swings, what happens to traditional long-term investing? Really think about that. If you're sitting there right now diligently contributing to a retirement account or trying to thoughtfully build a portfolio based on solid business fundamentals, how do you navigate a sea that is constantly being churned by a giant options hedging machine? It's a complex reality of the modern market, for sure, but understanding these hidden mechanics is the absolutely crucial first step to surviving them. Thank you so much for joining me for this explainer. Keep asking those big questions, and I'll see you next time.